The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is entitled Lessons from the IMF's Bailout of Greece. I now recognize myself for 5 minutes to give an opening statement. This morning's hearing, Lessons from the IMF's Bailout of Greece, will examine the International Monetary Fund's financial assistance to the country, one of the largest and most controversial rescues in the fund's history. Under normal access rules, the IMF had traditionally lent up to 200% of a country's quota per year. When the Eurozone crisis hit, the fund in 2010 approved an exceptional access program for Greece worth 30 billion euros, or 3,200% of quota, to supplement the Eurozone's own contribution of 80 billion euros. In 2012, the fund approved a second program worth over 2,000% of Greece's quota, with more than 18 billion euros in new money. Many observers, including on this committee, were critical of the fund's use of a so-called systemic exemption, which was created in order for Greece to tap exceptional access lending. This exemption claimed that potential spillover effects from a Greek meltdown compelled the fund to waive its requirement that a member's debt be sustainable with a high probability before the fund lent money. Thanks to pressure from Congress, the systemic exemption has since been repealed, but this shouldn't obscure the fact that the Greek bailout has made a mockery of other IMF lending rules too, as findings from the IMF's own evaluation office have made clear. Despite receiving exceptional access, Greece remains mired in recession, with youth unemployment approaching 50%. The IMF likes to speak of the catalytic role its financing can play in borrowing countries, but in Greece at least, the fund's resources have catalyzed nothing. 7 years after the IMF's first program, Greece's debt has worsened and is judged by the fund as downright unsustainable. Today, the Eurozone has set up its own bailout fund, the European Stability Mechanism, or ESM. It possesses more resources for just 19 Eurozone countries to borrow than the IMF can deploy for the entire world. At the same time, Greek capacity remains as doubtful as ever, with falling rates of tax collection, government arrears to domestic firms, and even the prosecution of the former head of Greece's statistical office, something widely viewed as a politically motivated witch hunt. In light of these facts, it is shocking that the IMF is now considering a third bailout for the country as a junior partner to the ESM. No one, not even the Europeans, pretends that the fund's financial assistance is needed. Rather, it is meant to protect Eurozone politicians as they head to elections this year. It is common knowledge that the IMF's contribution would be symbolic. But if that is the case, the fund may be on its way to becoming a symbolic institution. So make no mistake, if the IMF goes forward with a third Greek bailout, it will suggest that the fund has learned little from past experience, that its role as a lender of last resort is in jeopardy, and that its decision-making has been hopelessly politicized. The fund will have no one to blame but itself if congressional scrutiny of its activities tightens accordingly, including through future consideration of IMF governance reviews. As for those who claim that any IMF member, including Greece, retains at least some right to borrow, we should refer to the IMF's Articles of Agreement, which contain explicit provisions to limit loans or render a member ineligible to receive them. The articles stipulate that assistance shall be temporary and designed to meet balance of payments problems, provided that there are adequate safeguards. I would submit that 7 years and counting does not qualify as temporary, and that having the IMF and ESM hand money back and forth to each other is not the kind of balance of payments crisis that IMF members pay their quota for. As for adequate safeguards, Greece is the first and only advanced nation to ever default on the IMF. And last year's alleged wiretapping of IMF officials in Athens suggests that good faith agreements are unlikely. With the Eurozone attempting, as we speak, to force the IMF to water down its demands for debt relief, another safeguard is at risk of being made meaningless. In short, nothing less than the fund's integrity and adherence to its foundational principles is at stake here. I look forward to our witnesses' testimony and I thank them for their participation at this hearing. And I'll yield back the remainder of my time, and the chair now recognizes the ranking member of the subcommittee, the gentlelady from Wisconsin, Congresswoman Gwen Moore, for 5 minutes for an opening statement.
Well, good morning, Mr. Chairman and my colleagues. Today is yet another exceptional day where we're going to be taken to school with our distinguished panel of experts, including our own Dr. Wilson from the Congressional Research Service. I want to thank you for appearing, and I think we're going to learn, Mr. Chairman, about the important role of the International Monetary Fund. This work is neither straight nor is it easy. We are seeking here on this committee to evaluate the IMF's roughly $32 billion contribution to the first Greek rescue package in 2010 through the Exceptional Access Framework. The largest fund in history aimed at avoiding a Greek default and stemming contagion in the Eurozone and more broadly. The Eurozone crisis has revealed flaws in the architecture of Europe, and whether Greece is in or out makes a compelling case for further economic integration. Flaws that include flaws created for the benefit of European banks. Moreover, how the crisis is handled may speak volumes for the future of Europe and the Eurozone, with important economic, political, and security implications, both in the United States and globally. I realize that these are complicated issues, and I have my thoughts and opinions, but I'll reserve those because I'm truly interested in hearing from our expert witnesses. Two things I'd like to say. The role of the IMF in these situations is vital. And ongoing analysis and research that you guys, that they provide is irreplaceable. And so I hope that we can evaluate the facts surrounding these events that were made looking forward through the fog of economic uncertainty when there are no perfect answers and not with the full benefit of hindsight. And with that, Mr. Chairman, I would yield back the balance of my time.
Thank you. Today we welcome the testimony of Paul Bluestein, Senior Fellow at the Center for International Governance Innovation, and he is an award-winning journalist and author. His most recent book is Laid Low: Inside the Crisis That Overwhelmed Europe and the IMF. Mr. Bluestein earned his undergraduate degree from the University of Wisconsin and his master's degree from Oxford University. Meg Lunsager.
Can I?
Sure.
Yield?
You're Wisconsin.
Come on now. This is a well-educated panelist. I just want to point that out.
Got a fellow Badger in the house. Meg Lunsager is a public policy fellow at the Woodrow Wilson Center and a former U.S. Executive Director and Alternative Executive Director at the International Monetary Fund. Additionally, she is a former Deputy Assistant Secretary for Trade and Investment at the U.S. Treasury Department. She has a master's degree from the University of Maryland and a bachelor's degree from American University. Anna Gelpern, a professor of law at Georgetown Law and non-resident senior fellow at the Peter G. Peterson Institute for International Economics. She earned a bachelor's degree from Princeton University, her JD from Harvard University, and her master's degree from the London School of Economics and Political Science. Dr. Rebecca Nelson is a specialist in international trade and finance at the Congressional Research Service, where she focuses on the International Monetary Fund, the multilateral development banks, and other policy areas related to international economic affairs. Dr. Nelson earned her bachelor's degree from Johns Hopkins University and her PhD from Harvard. Each of you will be recognized now for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Bluestein, you are now recognized for 5 minutes.
Thank you very much, Mr. Chairman, Ranking Member Moore, members of the subcommittee. Thank you very much for the opportunity to provide my perspective at this hearing about a complex but very important topic. The IMF's role in the bailout of Greece is rich in lessons about the workings or non-workings of the international financial system and has immense implications for the future of the global economy. I've made something of a career writing books, behind-the-scenes books, journalistic narratives about the IMF and financial crises. And when I wrote a book about the Argentine crisis of 2001-2002, I thought I had chronicled the IMF's greatest debacle ever. But financial crises are kind of a gift that keeps on giving to people like me. And along came the Greek crisis, which is, I would argue, has been even worse, both for the country and for the fund's reputation. So I got to write another book, the title of which you kindly mentioned, Mr. Chairman. I'll mention it again if you don't mind. It's Laid Low: Inside the Crisis That Overwhelmed Europe and the IMF. Let me begin with a tidbit from that book. I think we're going to get this thrown up on the slide here. Yeah, okay, so then this is, I know we have time constraints, so this will be my only tidbit, I promise. But this is a memo that was a confidential memo that was written by Olivier Blanchard, who was then the IMF's chief economist. And he wrote this in May 2010 as the first bailout of Greece was nearing finalization. So this memo may be a little hard to see on the screen, I don't know, but the essence of it is he's saying this isn't going to work. The bailout, just some details, was the largest in history. At that time, 110 billion euros in emergency loans, 30 billion of which was to come from the IMF. The purpose being so that Greece could pay off all its obligations coming due over the next couple of years, reassure markets on that point, and avoid a catastrophic default on its debt. And in return, Greece was expected to drastically cut its government spending and budget deficit, and to get itself out of recession and growing again, the Greeks were supposed to implement a very large number of structural reforms. For example, streamlining the notoriously inefficient state-owned enterprises, the state railways, for example. So I've underlined sort of the money bits of Blanchard's memo. He says the degree of budgetary belt-tightening required of Greece has never been achieved by any other country. Furthermore, quote, even with full policy compliance, there is nothing that can support growth against the negative contribution of the public sector. The recovery would likely be L-shaped, with a recession deeper and longer than projected, unquote. So then he goes on to say the program is likely to go off, quote, off track even with perfect policy implementation, unquote. So to put that in a bit plainer English, what he was saying was that even if Greece did everything that was being asked of it, fulfill all the conditions, the Greek economy would sink further and the rescue program wouldn't work. Now, Blanchard doesn't say so explicitly in this memo, but the clear implication is that Greece would need a large amount of debt relief, much sooner rather than later. But powerful European policymakers were vehemently opposed at that time to giving Greece any debt relief, and the rescue went ahead as per the original plan, a gigantic loan with conditions. And when Greece finally did get debt relief in 2012, it was too little, too late. And this was typical of a syndrome that plagued the IMF during the Eurozone crisis. The fund joined in several rescues despite grave misgivings among top economic and legal officials there, and also some of the members of its executive board, and it did so under pressure from European policymakers who maintain heavy influence over the fund's levers of control. And some of these emergency loan packages, you have to say, worked out pretty well, but all too often debt was piled atop debt and excessively harsh conditions imposed on the crisis-stricken countries, and Greece was, I think, the canonical case in this regard. And this is a real problem in view of the IMF's mission. This is a mission I really believe in. The fund provides a global public good, a benefit that no single nation can provide by itself, but which all nations gain from the global public good of global financial stability. And the crisis in Europe showed us that this is more important than ever, because previously we thought that international bailouts were for countries in the emerging world, countries like Thailand and Indonesia, for example. And the Eurozone crisis showed us that advanced countries need bailouts too. So the world has really been put on notice about the importance of a muscular and effective IMF. But the Eurozone crisis, I think the Greek crisis above all, was a bruising and enfeebling experience for the IMF. Fund economists, to their credit, as this memo shows, perceive serious flaws in these bailouts, but they often yielded to the clout of people in capitals such as Berlin and Frankfurt and Brussels and Paris. Now, the IMF was more independent in the latter stages of its crisis, but in my view, it didn't use the greater leverage that it had to the extent that it should have. And this sapped the IMF of its most precious asset, its credibility as an independent, neutral arbiter. And this has disheartening implications for the management of future crises. So I'm out of my time, Mr. Chairman, I know I'll elaborate, happy to elaborate on these points in the Q&A, and I appreciate your incorporating my written statement in the record. Thanks.
Thank you, Mr. Bluestein. Ms. Lunsager, you're recognized for 5 minutes.
Thank you very much, Chairman Barr and Ranking Member Moore and members of the subcommittee. I spent much time discussing these issues while I was at the IMF and continue to focus on it at the Wilson Center, and my testimony today reflects my personal views. Over many decades, IMF policies and lending have underpinned the global economic and financial stability that we all seek. The IMF's early response to the Eurozone crisis was key in containing the spread of the crisis, which benefited all members. But IMF lending to Eurozone countries also strained IMF principles and weakened the IMF's lead role in designing economic adjustment programs and financing packages for countries facing a balance of payments crisis. IMF lending programs that normally encompass all aspects of macroeconomic and financial sector policy have been shaped more by European needs than by IMF standards. This eroded the IMF's commitment to treat its members uniformly in terms of the types of policy adjustments demanded in lending programs. Furthermore, Eurozone governments have created their own 500 billion euro financial rescue fund, the European Stability Mechanism, and therefore do not need IMF funding. With little likelihood that Europe will adjust its internal rules and regulations to accommodate the IMF, the preferred future approach is that Eurozone countries do not seek IMF lending. Eurozone members nonetheless retain their right under the IMF Articles of Agreement to request IMF financing. The IMF should therefore have in place a defined policy establishing its primacy in program design and its seniority among all creditors in lending to currency union members. The IMF requires that borrowing countries implement economic reforms designed to restore financial stability and balance of payments viability. Programs include conditions on monetary, fiscal, financial sector, and exchange rate policies. If a country is a member of a currency union and cannot adjust its exchange rate, domestic macroeconomic policies will be tightened further to restore competitiveness. The IMF will also work closely with bilateral, multilateral partners as aid and credit programs provide technical assistance and critical funding. Debt relief from official and private creditors may also be included in the financing package if the IMF assesses that the country will be unable to meet its debt servicing commitments or borrow new funds from private markets. Greece is the only Eurozone member now seeking IMF assistance. European partners reaffirm they are committed to providing additional future debt relief to Greece if needed, and if Greece adheres to its reform program through 2018. The IMF has stated that European assumptions are too restrictive, and the IMF continues to demand more clarity now from European partners regarding the extent of additional future debt relief European entities will provide. European finance ministers will meet on Monday to discuss their response to the IMF. Greece's outstanding debt to the IMF has dropped to less than $14 billion, while its debt to European partners remains over $200 billion. With little financial need for a parallel IMF program, the Eurozone should assert its lead role in addressing its internal economic challenges and move forward without an IMF program for Greece. The IMF cannot fix the Eurozone's internal inconsistencies. Only Europe can. However, as I mentioned, under the Articles of Agreement, each country is entitled to request IMF financial assistance. Therefore, the IMF should establish a policy governing how it will lend to members in a currency union, particularly those in a reserve currency union such as the euro. Recognizing this need, the IMF is planning to discuss conditionality in currency unions this summer, according to their work program. The approach should include a process for the IMF to participate in designing the country's economic reform program and monitoring its performance without necessarily providing financial assistance. If the country requests IMF financing, the monetary union should respect the IMF's lead role in all elements of program design and debt sustainability assessments. The currency union's institution should share the information on their policy requirements and defer to IMF program requirements. The IMF contribution should be relatively small and shorter term than some of the recent programs have been with Eurozone countries. The currency union's members and leading institutions should explicitly recognize the preferred creditor status of the IMF, including with regard to their earlier disbursements. An IMF policy along these lines would clarify respective institutional roles and help point Eurozone countries towards addressing their own internal imbalances. I look forward to your questions. Thank you.
Thank you. Professor Gelperin, you're recognized for 5 minutes.
Chairman Barr, Ranking Member Moore, thank you very much for including me, and thank you to the members of the subcommittee. I am especially honored to share this panel with people I respect tremendously, so it's a special pleasure for me to be here today. I write about financial regulation and sovereign debt restructuring, so I'm really looking at this very much from the perspective of the global sovereign debt restructuring regime rather than EU or Greek equities in particular. My main message is that the IMF remains indispensable in the sovereign debt restructuring regime. It's absolutely true, I agree with my colleagues, that Greece has tested it like no other. However, like no other actor, the IMF has shown capacity to learn from its mistakes, has undertaken substantial reforms, and paradoxically now probably has more policy sway with less money on the line than it did earlier on. I think we should encourage this trajectory, reinforce the fund's independence. In other words, I think the lesson of Greece is that we need a stronger IMF, not a smaller, weaker IMF. As you know, sovereign governments that run out of money cannot file for bankruptcy. This is not just a problem for the borrowing country and its citizens, but also for its creditors, who are doomed to scramble for bits and scraps in a crisis because the sovereign government is immune. Against this background, the IMF plays a vital coordinating role. It is literally the only actor capable of bringing together diverse domestic and external constituents around a reform program, and has developed unparalleled expertise in crisis management, to be sure, nourished by its many mistakes in the past, including some of the ones that Paul has written about so beautifully. My written testimony outlines in painful excess detail the sovereign debt restructuring context, focusing on the role of the fund, and summarizes recent restructuring experience and how this role has come to be. Now, sovereign debt restructuring reform is not all about the IMF, far from it, but it cannot happen without the IMF. I believe that in the wake of Greece in particular, reform should have 3 objectives. Outcomes should be sustainable, the process should be comprehensive and collective, and the regime as a whole must be intelligible and accountable to its constituents, both debtors and creditors. Now, Greece does illustrate, again, painfully, the risk of entangling analysis, money, and politics. I think that when those 3 come together, analysis always loses, and that's a big problem. With respect to the first objective, sustainable outcomes, the IMF should be applauded for reforming its approach to assessing countries' debt sustainability, opening up its methodology to outside scrutiny. In Europe, the IMF has been, despite all of the stumbles and mistakes, a force for good. Again, the question is, where would we be without the IMF? What would European Union assumptions be, and where would Greece be if the IMF were out of the picture completely? I believe the fund has pushed EU authorities to be more realistic in their projections, and Paul's smoking gun memo is actually one example of that, even in the face of political constraints. That said, I continue to believe that debt sustainability analysis should be further open to debate and competing views, and also in order to reduce the pressure on analysis, I believe that we need a credible story for how the international financial system deals with contagion. Because contagion, you know, the C word, has this magical effect of killing all analytic effort. Now, without bankruptcy, you have piecemeal official, private sector, domestic, external restructuring and default. And I think, again, the IMF alone is able to and has shown capacity to bring together the various parties. I'm particularly delighted that the fund has begun to address the role of official creditors. Central banks, the ECB was paradoxically the biggest holdout in the Greek debt restructuring in 2012. There are other, even more difficult examples around the world. And finally, I think there is no bankruptcy for sovereigns, but there has been a pretty regular and discernible regime. But this regime, the sequencing of debt restructuring, what the different actors do, is completely unintelligible and inaccessible to ordinary people. The IMF is ideally positioned to promote more transparency and intelligibility. It can easily require uniform, comprehensive disclosure, and I think it should use its power to advance this goal. To close, the IMF is in a peculiar position. It is doomed to be small relative to global capital flows. But the fact that it has more clout in Greece now with less money on the line, I think, is instructive. Credibility is immensely important. We should help the fund hold the line, continue to rebuild its credibility, and be a force for good. Thank you.
Thank you for your testimony. And Dr. Nelson, you're now recognized for 5 minutes.
Chairman Barr, Ranking Member Moore, and members of the subcommittee, thank you for the opportunity to testify on lessons from the IMF's bailout of Greece. My testimony focuses on the policy implications of the Greek crisis for the IMF as an institution. I will summarize my statement with these brief remarks. The IMF has decades of experience responding to economic crises around the globe. The Greek crisis, however, took the IMF into uncharted territory. Greece was the first advanced economy to borrow from the IMF in decades, and the IMF committed significant financing in 2 back-to-back programs. The IMF entered an unusual co-financing arrangement for Greece with European creditors. It was also the first time that the IMF had designed a program for a country in a major currency union. The IMF's record in Greece is mixed. IMF programs helped limit spillover from Greece to the global economy, which was struggling to recover from the global financial crisis. But 7 years after the first program, Greece's economy remains in crisis. The IMF's experience in Greece raises a number of broad policy questions about the IMF that continue to be relevant in Greece and are likely to arise in future crises. I will talk about 4 such questions. The first question relates to the size and length of IMF financing. Although Greece is an extreme example, there is a broader trend towards larger IMF programs and for some countries to require repeated IMF programs. This raises questions about whether there are or should be limits. On one hand, long-term financing veers from the IMF's mandate to provide temporary financial support. Additionally, there is the potential for moral hazard. Governments may be less likely to adopt prudent economic policies if they believe that the IMF will step in regardless of the cost. On the other hand, limiting the resources that the IMF can deploy during crises may pose risks to the broader global economy. The second question relates to co-financing. In Greece, IMF co-financing with European creditors limited IMF exposure to the crisis. It also limited the IMF's independence in designing programs for Greece. The IMF does not have a clear policy on co-financing arrangements. There are questions about whether co-financing is desirable, and if so, how co-financing arrangements can be designed to maximize their effectiveness. The issue of co-financing is likely to remain salient. Regional financing arrangements have proliferated in the global economy. The third question relates to IMF policy flexibility and accountability. The IMF revised its lending safeguards in 2010 to allow the Greek program to go forward, despite misgivings about Greece's debt. The IMF believed that the risk from Greece to the global economy justified the policy change. The policy change was controversial and eventually repealed. Going forward, this raises questions about the appropriate balance between IMF flexibility and adherence to safeguards. Providing the IMF discretion to make policy changes allows the IMF to respond to unforeseen and time-sensitive crises. The risk is that the IMF may adopt policy changes that donor governments do not support and may also make the IMF less predictable as an institution. The fourth and last question relates to currency unions. A currency union is where 2 or more sovereign states adopt a common currency. Greece belongs to a currency union, the Eurozone. The crisis in Greece was fundamentally tied to structural problems in the Eurozone. The IMF, however, does not design programs for currency unions. The IMF designs programs for specific countries. For Greece, this meant that IMF programs were focused on a relatively narrow set of policy issues and tools. Arguably, the IMF programs required a broader scope that addressed the Eurozone crisis as a whole. How the IMF should respond to crises in currency unions remains a challenge for the institution. In conclusion, the IMF is an institution that has evolved over time. After a number of major crises, the IMF has adapted policies based on lessons learned. Greece is another pivotal crisis that raises questions about IMF policies and the IMF's role in the global economy. Congress plays a critical role in shaping U.S. policy at the IMF, and Congress may want to consider these policy issues. Mr. Chairman, this concludes my brief remarks. Thank you for the opportunity.
Thank you all for your testimony, and the chair now recognizes himself for 5 minutes. As many of you all alluded to, the Greeks still suffer from the Eurozone's highest unemployment rate. It's around 25% for the past several years. And instead of helping to reduce Greece's public debt to GDP ratio to 110% as planned, the fund has witnessed the debt to GDP ratio climb to nearly 180%, despite a major restructuring of debt in 2012. So the logical conclusion is that the IMF's involvement has done little to improve the lives of the Greeks, in part because Greece's leaders have slow-walked reforms for years. In December 2015, Greek Prime Minister Alexis Tsipras was unapologetic, criticizing the fund's, quote, unconstructive attitude on fiscal and financial issues, unquote. He indicated the IMF should stay out of any future bailouts and was quoted by the Financial Times as saying, after 6 years of managing an extraordinary crisis, Europe now has the institutional capacity to deal successfully with intra-European issues. I would ask that this Financial Times article with the headline, Alexis Tsipras pushes for IMF to stay out of next Greek bailout, to be entered into the record. I would also ask to enter into the record a Reuters article from January of this year noting that the Greek government would welcome the IMF's being excluded from the Europeans' bailout. So for Dr. Nelson, according to the IMF's Articles of Agreement, assistance can only take place at a member's own initiative. If the leaders of a member like Greece believe that the country's crisis can and should be resolved by Europe alone, shouldn't the IMF take Greece at its word?
Well, so as you say, the IMF provides financing to countries that request it, and if Greece isn't requesting financial assistance, the IMF shouldn't be providing financial assistance.
Mr. Bluestein, would you agree with that?
Well, I think the Greeks will probably, under such circumstances, have their arms twisted and told that they should request IMF help if there is a deal. Of course, there's a big meeting expected on Monday, the Eurogroup. I mean, Tsipras does score political points by attacking the IMF because the IMF has been, in many ways, tougher than the European creditors in insisting on various structural reforms and insisting that targets be met. And so he lashes out at them, and I think it's to his political advantage to do so. But I would bet that if there is a deal, he will.
Could you turn on? Is your microphone on, sir?
I'm pressing talk. Can you not hear me, sir?
Pull his mic up to your mouth.
Oh, okay. Sorry.
Pull your microphone towards you, sir.
Okay.
Thank you very much.
Okay. Sorry. Oh yeah.
There we go. That's good.
That's
Thank
better.
you.
Okay, I could hear myself, but anyway, sorry. So my basic point was that that I think, although Tsipras loves to beat up on the IMF for political reasons, if there is a deal that the IMF can live with, my guess is that the European creditors will twist his arm and tell him that he has to ask for aid from the IMF. So that formal request would be forthcoming. That's my. But we don't know what's going to be happening next week.
Well, one of you all referred to moral hazard, and it does sound like the IMF is creating moral hazard. If IMF were to move forward with a third bailout, IMF would be giving Greece a third credit card to max out and incentivizing the very behavior that got Greece into trouble in the first place with little or no meaningful prospect for a long-term sustainable solution. It seems to me that Greece needs to enact some tangible reforms that would lead to growth and increased revenue. Ms. Lundsager, do you agree that a third bailout would create that moral hazard?
Mr. Chairman, I have a hard time dealing with moral hazard because when I see what countries have to go through, I never felt that the IMF created the incentive for countries to mismanage their economy and then come to the IMF for help, because as we've seen, especially in the case of Greece, how painful that is and how Mr. Tsipras has had to walk back from earlier claims of, well, we're not going to invite the IMF in. He must already have approached the IMF and said, I want another program because the IMF has been part of the team's that have been in Athens negotiating the policy package. So on the moral hazard side, perhaps there's some moral hazard on the part of the private sector that thinks they'll be able to get out before a debt restructuring happens. But at this point, there isn't too much private sector debt left. It's all been turned into official debt on the part of Greece.
Thank you. My time has expired, but I would invite, as the questions continue, the other panelists to comment on that issue of moral hazard. And with that, I now recognize the ranking member for 5 minutes.
Thank you so much, Mr. Chairman. And of course, you know, I have more questions than answers as we see the evolution of this. And I was real interested in what seemed to be a consistent theme with all of you, that there are structural reforms that were needed. But there's, Mr. Bluestein, you talked about the belt tightening not having been achieved. And I guess I want you to share with me briefly why you thought that that hadn't occurred. Was the conditionality too great? In particular, I want to know if there was some conditionality with regard to requiring Greece to collect taxes aggressively from the oligarchs there.
Well, there was conditionality of that sort. I think on the fiscal conditionality, it's fair to say that Greece delivered on a lot of that. That was kind of part of the problem. The belt tightening part of the program worked. I mean, it had a very dampening effect on the economy. The theory of the first program was, Greece had an exploding debt to GDP ratio. That was what everyone was worried about. So if you tighten, fiscal policy and the country can run big surpluses as they were projecting, then the country would be able to pay down its debt. The trouble is that takes money out of people's pockets, so then GDP falls. So the theory was, well, how are we going to get this economy to grow, to get out of this trap that it's in? Now, Greece is a member of the Eurozone. They're not allowed to cut interest rates. They're not allowed to pump up the money supply. They're not allowed to devalue their currency, as many countries do when they're in situations like that. So what the theory was, we'll have structural reforms, and that'll increase the efficiency of the economy, and that'll help pump up growth. And a lot of those structural reforms made, I think, very good sense. You can't argue, I think most economists wouldn't argue, with the value of making state-owned enterprises more efficient, liberalizing a lot of, the professions that had been kept closed to help special interests.
But I mean, in the long run, I mean, austerity was just not the answer to it, that didn't work.
I'd put it slightly differently. The idea of I guess, and this is the main point of Blanchard's memo in a way, is that the structural reforms will take so long to work. I mean, they will have beneficial impacts eventually, but the effects of the austerity dampening the economy will be so great, and the structural reforms actually in the short run often have a negative impact on the economy.
You're interesting. We're going to have lunch. Yeah. But I want to hear from Dr. Nelson and the ladies here, because you all have all talked about the importance of the IMF having been there in the beginning to prevent the contagion from spreading. And so, Dr. Nelson, Professor, let's just have a dialogue for the next 1 minute and 43 seconds. Go for it.
So I do think the IMF programs were successful in stemming contagion of the crisis. I think it's important to remember that when the first program for Greece was approved in 2010, it was on the heels of the global financial crisis. And there was broad consensus among the international community.
Right, and Paulson came and asked for $700 billion, not $32 billion. But go on.
Right.
Just saying.
And so I think the IMF programs did contribute to preventing another sort of Lehman-style shock to the system. However, I don't think anyone believes that the economic situation in Greece has been successful, or that there's even a long-term plan for restoring economic viability in Greece.
Dr. Gilpern, I mean, the intellectual benefits of the IMF's intervention are what?
They're the only ones that literally have the methodology that has been tested. that can tell a credible story. And they also have an internal organization that enables some kind of debate, and they have a board, including the United States, that can exercise checks and balances, right? So I did want to return and connect this to the topic of moral hazard.
Yes.
I think the one type of moral hazard we're not talking about is political moral hazard.
Aha.
And there are two types of political moral hazard that we see in Greece. One is exemplified by, I guess trash talking is not a very polite way to describe Mr. Tsipras' occasional comments on the role of the international community. But they're free to say that when they know what's going to happen behind closed doors. And he was saying it after the IMF had stopped disbursing for almost a year and, less than a month before the program was formally done, right? So in that sense, I think that it is absolutely true that the IMF should not be financing countries that are not truly committed to the program, but I'm not sure that this commitment necessarily follows from the leader's words. But the other one, and I'll just mention it briefly, and I'm happy to elaborate later, is the moral hazard of European leaders telling their own citizens that they're going to be repaid in full, right? And the fact that over 200 billion euro in government-to-government debt is now on Greece's back for whatever.
The gentlelady's time has expired.
I'm sorry.
Thank you.
I thank you for your indulgence, Mr. Chairman. This is fascinating. We have other members here, and so maybe we'll get a chance to get to Ms. Lunsager and hear more. Thank you so much. You guys are so brilliant. You gals.
Thank you. The
guy.
chair now recognizes the vice chairman of the subcommittee, Mr. Williams.
Thank you, Mr. Chairman, and for all the witnesses, thank you for your testimony today. I think it's safe to say, Mr. Chairman, that in business, the private sector, you want to make sure you get the best deal for your company and your shareholders. In this case, the shareholder, the American taxpayer, should be confident that their money is being spent wisely. And just like any business deal, when a deal goes bad, sometimes you have to walk away and cut your losses. According to some of our testimony today, Greece's outstanding debt to the IMF has dropped to less than $14 billion. Greece is currently paying 3.8% lending rate to the IMF. The interest rate to the European creditors is only 0.72% on roughly $200 billion. The European Stability Mechanism's 2015 annual report proudly underlines that its financing is a fraction the cost of the funds. My first question is for Mr. Bluestein. If the ESM provides cheaper financing than the IMF, why should the Greeks be forced to take on the fund's pricier loans? And if an individual is facing financial disaster only had 2 credit lines, wouldn't we advise them to go with the lowest interest rate possible?
Well, the problem is that the countries like Germany, the Netherlands, Finland, members of the Eurozone that would be endorsing the provision of ESM money for Greece, those countries are insisting that the IMF be there, putting some of its own money on the line and providing its seal of approval. So it's a bit of a catch-22. But in theory, you're right. If the Europeans want to do it themselves, and particularly if the IMF feels that that Greece is not being put in a sustainable debt position, the IMF should, whatever Greece wants, whatever Germany wants, the IMF should say no.
Ms. Lunsager, could you talk about that, please?
Thank you, Congressman. We'll get a bit of an answer to your question on Monday when the European ministers meet to discuss this, but I'd be delighted if they decided to use the ESM funding to basically clear off Greece's obligations to the IMF. I think it would be a benefit to Greece. It's as Mr. Bluestein said, the other European capitals want the IMF involved for credibility of the adjustment program, but my concern is that Europe itself needs to do more to develop its own internal unity to become more of a union, and bringing in the IMF may not necessarily help them do that when they have to grapple with the changes they need internally to make themselves function more as a union. And of course, we saw the meeting between the new French Prime Minister, President, and and Angela Merkel earlier this week, off to a very good start. But there's still wide divergences between those two key economies. If they can agree on some of the reforms needed, perhaps then there'll be a way forward. But I still do not believe the IMF is the one that ultimately can fix this monetary union.
Okay, thank you. Dr. Nelson, why would we take the IMF's concerns about debt seriously if the Fed doesn't insist on the Greeks receiving the least expensive financing available? And if the fund is serious about Greece's debt burden, shouldn't it step aside and let the ESM provide cheaper financing?
So I think that's certainly an option that the IMF could pursue, is that if debt sustainability is the issue, go with the cheapest source of funding. I think one issue that people are talking about is there a role for the IMF to play in responding to the Greek crisis through sort of technical assistance in helping Europeans design the program without putting forward money itself? And so that might be one option that people are exploring.
Okay. Dr. Lynn Sager, the IMF has concluded that Greece needs significant debt relief. Would you agree that debt relief is required for Greece's debt to become sustainable and to prevent further bailouts past 2018?
Absolutely, Congressman, and my preference would be for an outright haircut on the principal, the outstanding principal, so that the Greek population, the private sector, wouldn't see this 180% out there, but that's not what the Europeans are prepared to do. What they're prepared to do is greatly, well, we'll find out how far they'll extend grace periods and maturities to basically have the equivalent of having a reduction in the outstanding principal. But restoring incentives to invest, to hire in Greece, I think is a real challenge, and we're not quite getting there yet.
Real quick, Dr. Bluestein, could you say something about that?
Well, I completely agree. I mean, it certainly would be preferable if Europe would agree to outright forgiveness, and the moral hazard that Professor Gelpin referred to before of you need to say to Europe, look, you lent money foolishly to Greece in 2010 and thereafter, and if we keep sort of enabling you to do that, we understand that you have political problems explaining this to your citizens, that you're not going to be repaid in full, and you can go on doing what Meg Lunsager referred to as the extending the maturities, but that's I think I would say a poor way to go about really helping the Greek people get some hope of some getting out of the trap that they've been in now for the past 7-8 years.
The gentleman's time has expired.
Thank you for your time.
And the chair now recognizes the gentleman from Michigan, Mr. Kildee, for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for holding this hearing, and for the panelists, thank you very much for your participation. I do have to note, I noted with a little chuckle that the comment about Mr. Tsipras engaging in trash talk in the effort to pander to a domestic political base that might also degrade the standing that he and the nation he serves might have is a lesson that could be applied to a number of countries, including the one that we're all sitting in right now. So you don't have to comment on that unless you want to. I'd be interested in pursuing a little bit more where Ms. Moore left off on the question of austerity and other conditions. And starting with Mr. Bluestein, you mentioned, I think you said anyway, that it's your analysis that the belt tightening essentially worked. I wonder if you could just explain that in a little more detail, and also expand that to touch on the other sort of systemic reforms that have a longer curve to them, and what the balance, what your assessment, and perhaps each of you could manage a point on this, what you think the balance of those might be, and secondly, if whether or not additional measures in either category would apply in order to follow up on Ms. Lunsager's notion that you might all comment on also, on whether or not principal reduction would come with pretty significant other conditions in order to achieve that. You could each comment
Just to clarify, when I said that the austerity worked, I guess what I mean is it was, to a large extent, it was delivered on. I mean, Greece did undergo a tremendous amount of fiscal consolidation on both the spending and tax sides, right? So that it worked too well. It killed the Greek economy.
That's where I was going, because when you said it worked, you meant it worked in that they complied.
They delivered on that. On so a lot of the structural reforms, they actually didn't deliver. And one of the arguments that's made in defense of the original program is, well, and this is the IMF, I'm sorry to say, they often do this when their programs don't work. They say, well, the country didn't deliver. They didn't do what we asked. They didn't fulfill the conditions. And it's, you can't say, you have to admit that Greece didn't deliver on quite a number of the structural reforms. I would argue that even if Greece had delivered on those structural reforms, as I would argue that Blanchard, in retrospect, was absolutely right. Even if they do all that stuff, those structural reforms are not going to help. They're not going to offset the effects of the austerity, because those things take a long time to work. In the short run, they actually have a dampening effect on the economy. I mean, if you're streamlining an inefficient, state-owned enterprise, you're laying people off, and those people have less money in their pockets. So now it may be a good thing to do in the long run, because those jobs are inefficient, and you need to make the economy work better. But when I say the austerity worked, I don't mean to suggest that it worked.
Okay, that makes more sense, because I was curious as to how much of what Mr. Barr referred to in terms of the now increased debt to GDP ratio could be attributable to the lag in the economy that was precipitated by some of those austerity measures. I wonder if the other panelists might also comment on this general subject.
No, I do think that Mr. Bluestein's absolutely correct. The austerity in terms of contracting the economy made it even more difficult to then address the debt. But the other side of the coin is Greece has lagged on the structural reforms that it needs, and they are very difficult. They are the kind of labor market reforms. In order to get employers to hire more workers, they need to be able to actually occasionally fire workers, and there are very stringent worker protections in Greece. Additionally, pensions and other benefits were increased substantially after Greece joined the euro, because they had access to very low interest rate money as a part of the Eurozone, and basically made a lot of promises that the real side of their economy couldn't deliver, didn't have the productivity, the competitiveness to deliver the real output that could then satisfy those pensions and the other commitments they made. So Greece is now struggling to try and do some of that, but in the meantime, given how tough the austerity is, and the Europeans are demanding very tough austerity for a number of years, to get back to debt sustainability, which is what will be, I think, and the IMF is pressing back and saying, no, that's not going to happen. You need more of the upfront debt relief. I do think it's going to be very difficult to generate the kind of confidence in the Greek private sector that will create jobs, will increase production, will revitalize that economy. Thank you.
Thank you very much.
The gentleman's time has expired, and the chair now recognizes the gentleman from Indiana, Mr. Hollingsworth.
Good morning. Thank everybody for being here. I really appreciate all of the insights that have been shared so far. I wanted to turn our attention to something that I think Dr. Nelson and Ms. Lunsager brought up, which is the IMF's effectiveness operating inside a currency union. Today, I think a quarter of IMF membership is made up by countries that are involved in some sort of currency union. So I think this is a problem that we're going to see in the future. So for a moment, setting aside primacy of repayment, but focus just on the economic issues themselves and the challenges that the IMF may face in responding to a crisis for a country that is in a currency union. Could you start, Dr. Nelson, and talk about the economic challenges associated with that?
Sure. So the IMF designs programs for countries. It doesn't design programs for currency unions. And so I think how that played out in Greece was the crisis in Greece was tied to fundamental imbalances across the Eurozone. But the IMF program, by focusing only on policies, regulations, things under the authority of the Greek government, it was only looking at sort of one piece of a bigger puzzle.
Correct.
And so I think some of the problems that we're seeing play out in Greece now are tied to this sort of very sort of narrow sort of look at the crisis as it played out.
Right. Ms. Lunsager, would you like to add to that?
Yes, thank you. In dealing with the currency union, then, the IMF had to take monetary policy as a given, interest rate policy, exchange rate policy as a given, so that greatly narrowed the tools available.
Right.
And of course, those policies were set for the entire Eurozone or for an entire currency union, not for the country itself.
Right.
So really monetary conditions were too tight for Greece. They could be looser. And you see that tension still within the monetary union right now, within the Eurozone, as some countries, Germany, complain that monetary policy is too loose. So in terms of being able to actually undertake the kind of policy measures that would normally be in an IMF program and help a country recover and make it, well, if you have a monetary policy you
Correct.
can use or an exchange rate policy, you need less of the fiscal contraction.
Right.
Thank you.
Mr. Bluestein.
This is a really great question, and it's something I wrote about with some, I guess you could say, passion or maybe even sort of starry-eyed, crazy idealism in my book. The IMF was coming to the rescue not only of Greece, it was coming to the rescue of the euro, of the European Monetary Union. And the IMF had been put in at the outset of the crisis in a position of a junior partner in the Troika, right, with the European Commission and the European Central Bank. I would argue that the IMF should have played a senior partner role. In fact, I argue that it should have played a super senior role, meaning I think the IMF should have been in the position where it was able to say to all of Europe, the following things are going to happen, not only in Greece, but in Europe. The ECB is going to do this, and Germany is going to do that, and you all are going to be doing this on banking union and whatnot.
Right.
I think the crisis would have been solved a lot sooner. I think it would have been a lot easier to have a debt restructuring in Greece So anyway,
like you said, kind of wrong tools for this situation, or an inability to be able to diagnose and treat all of the symptoms at the same time, instead focusing on a single symptom in hopes that that would migrate to other aspects. So I guess I'd start again with Dr. Nelson. Is this a permanent defect or inability of the IMF to handle a currency union crisis? Or given the players that you probably know, have seen more than I, do you think the IMF will be able to effectively work with the currency union as a whole to be able to get at some of the other symptoms?
Sure. So the IMF's Articles of Agreement doesn't talk about programs for currency unions. It's not something that, is sort of by design. The IMF has started grappling with this issue. For example, in its surveillance programs, it started having Article 4 consultations for the Eurozone as a whole. And so, but I do think there's a mismatch still between with the programs. Is it appropriate to design programs for specific countries, or do they need to address the broader, currency union as a whole? And it's not clear that sort of the founding document, the governing document of the IMF addresses
It's
that
clear that the
issue.
problem exists. It's not clear whether the IMF can solve that.
Right. And I would also add that through design, by focusing on specific countries rather than the broader Eurozone as a whole, it imposes all the costs of adjustment on the weaker members of the currency union. It exempts the stronger sort of members from playing any part of the adjustment process.
Correct. Which they certainly had a part in creating the problem.
Right.
Correct.
Right.
Well, my time has almost expired, but again, I want to reiterate my deep concern that the IMF's inability to get at all of the symptoms of the disease will lead to a poor outcome both for the Greek economy and ultimately I worry about for the IMF as well, that they don't have the tools to be able to tackle the problem when we expect them to do so, and asking them to do more than they can do and then holding them accountable for the failure to do so is probably inappropriate for both the institution and for the Greek economy itself.
The gentleman's time has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney.
Thank you, Chairman Barr and Ranking Member Moore, now represented by Foster, for allowing me to participate in this hearing. And I am a strong advocate for Greece. I believe that it is critically important that Greece remains in the European Union. And I believe they have been strong allies to the United States, and our relationship remains strong as Greece endures an unprecedented economic crisis. It has been a strong pillar of democracy and stability in the West and plays a vital role in protecting U.S. security interests in Europe. One of our major bases is placed there. So I thank the chairman and the ranking member for holding the hearing, and I'd like to ask Mrs. Lunzinger about debt relief for Greece. You noted in your testimony that debt relief could provide additional fiscal resources for Greece, which could be used to invest in her economy and for additional social services which are badly needed. In other words, the less money that they have to pay to the European creditors, the more money it will have to get its economy going again. And I recall in our own financial crisis, one of the ways that we dug our way out was not through austerity, but through really stimulus packages and ways to stimulate the economy and investing in our infrastructure and really investing with resources into our own economy. So my two questions for you are, first, do you believe that debt relief is a necessary component of a new lending program, whether or not the IMF is involved in the new lending program?
Yes, Congresswoman, I do believe that no matter what, whether the IMF is involved or not, debt relief needs to be part of the future relationship the Europeans have with Greece.
What about the other panelists? How do you feel? How would you respond? I'll invite anyone who would like to respond to respond.
If I may, Congresswoman, I agree entirely that debt relief is essential, and I also want to second Ms. Lanziger's point that principal reduction, I think, is not just economically but politically important. And in this picture, the IMF stands for relief and reform, which are two things that are critical for Greece. The European Union is a bit of a question mark on both. So I have no religion about whether the IMF puts in money. In fact, I'm delighted that they're able to exercise influence without it. I think it's great for us. But I do think that it is advocating the right thing, and debt relief foremost among them, and I think it should stand firm. Thank you.
Okay, and second, Ms. Lunsinger, do you think the best form of debt relief would be a reduction in principal, as some have advocated, or would simply extending the loans and lowering the interest rate be sufficient?
Thank you. I continue to believe that outright principal reduction would be best, and I come back to my earlier comments that this would be a signal to the Greek economy then that there would not be a future very heavy burden of debt repayment, even if it is far in the future, because what Greece needs is investment, it needs job creation, it needs internal growth. The IMF and the Europeans have been very clear that they will not do that. And so the IMF has pushed them to have such very long grace periods and maturities on the outstanding debt that for all practical purposes, for decades, Greece would be paying very little back to its European partners. So that's certainly a second or third or fourth best option. But Greece is part of this Eurozone. They've chosen to be part of this Eurozone. And so that means they've got to work it out within the Eurozone too, that the IMF is not in a position to dictate how the Eurozone undertakes its internal deliberations and agreements. Thank you.
Do you think it would be better for Greece to just leave the European Union and the debt and just go on their own? Are there any comments on that from the, starting first with you, Ms. Lanzinger, and then Ms. Galpern?
You know, thank you. If Greece had dropped out of the Eurozone, perhaps not the EU, the European Union, but had dropped out of the Eurozone years ago, ultimately in the long run, it probably would have been better off because it would have had a very large devaluation of its, let's say if it went back to the drachma, and that would have helped restore competitiveness and bring jobs back. With that said, that's not what the Greek population wanted. The one thing that's been clear year after year after year is that they want to stay in the Eurozone, which at times I've found a little bit remarkable. So in that case, it's their own choice, too, to undertake the reforms that they need to stay in.
The gentlelady's time has expired. Thank you, Ms. Lunsinger. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
I thank the chairman, thank the ranking member for holding this hearing. I agree with Mrs. Maloney's comments that Greece is certainly an important long-term partner in Europe and a longtime friend of the United States. But this structural differences that we have about the role of the IMF and in the EU are really illustrated in this hearing today. Dr. Nelson, I noted in your testimony that you noted how the IMF's first bailout socialized much of the private debt that Greece had owed. And much of this debt was held by German and French financial institutions. And back in 2010, the former head of Germany's central bank said in an interview, and this is a quote, "The bailout was about protecting German banks, but especially the French banks, from debt write-offs." On the same day that the rescue package was agreed upon, shares of French banks rose by 24%. You know, looking at that, you can see what this was really about, which was rescuing banks and rich Greeks, he says. And I asked that this interview be entered in the record, Mr. Chairman.
It'll be entered into the record.
Thank you. So Germany and France are two of the richest countries in the world, and if you believe that their banks needed to be propped up, is it really the IMF's job to recapitalize rich country banks? Doesn't this just present a conflict of interest on the part of the IMF's board of directors? What are your thoughts on that?
So I think one thing people have talked about after the experience of 2010 was, would it have been better to let Greece default in 2010 and use the money, European money, to recapitalize French and German banks? Would that have made the banks better off? Would that have addressed the contagion issues? And would Greece be better off today without this sort of large outstanding debt? However, it's not clear that there was a mechanism in place to do that. We didn't have a European stability mechanism at the time. We didn't have a process for recapitalizing banks. But in hindsight, this is something that I think people have talked about. I also think it gets at the issue of moral hazard. We've talked a lot about political moral hazard or moral hazard by governments that borrow from the IMF, but there's also moral hazard from private investors who make investments but may not bear the full consequences of investments that they've made when it goes bad.
This committee knows something about that, watching Puerto Rico. So what's the lesson, Mr. Bluestein, just a moment, I'll come to you. What's the lesson for the ECB and Europe on the European mechanism is one item. What other reforms should Europe take into account to kind of solve their own internal currency zone issues like this?
I think two of the issues that have been discussed are greater coordination of fiscal policies and the creation of a European banking union, both of which are in progress, but it's not clear to me, have those policies been completely harmonized and coordinated across the Eurozone or the broader EU?
Mm-hmm. You think we'd still have faced a similar challenge that we have even if they had been harmonized, or do you think it would have been a different policy outcome?
I don't know. I don't know how it would play out if we had a similar situation today. I mean, there are certainly institutions that have been created, like the European Stability Mechanism, that could help address a crisis that didn't exist in 2010. But it's not clear if they would, do something to address the issues in the banking system rather than address the issues of a debtor government who owes money to French and German banks.
Right. Mr. Bluestein, let me let you comment.
Yeah, I just wanted to come back to your point about what the motive was for the original bailout and whether it was saving German and French banks. I spent a lot of time interviewing people for my book about, and that was one of the questions that I looked into a lot. And I would have loved to have found a smoking gun indicating that this was a major motive for the key players, either in Europe or at the IMF. And I'm not. There's no question. It was. French officials in particular were keenly aware of the exposures of banks like Société Générale and Paribas and so forth. They had large exposures to Greece, and I don't doubt for a minute that this was a consideration for them. But I think I take people at their word when they say that their main concern, the main reason why they adopted the approach that they did, was fear of contagion. If Greece was going to be allowed, if Greece was either going to default or be allowed to restructure its debt, this was going to have knock-on effects. People would dump the bonds of other, vulnerable countries in the Eurozone. This is certainly the thinking of Jean-Claude Trichet, the president of the European Central Bank. I'm very critical of Jean-Claude Trichet's a lot of the positions that he took during the crisis, but I do think he was sincere in his concerns about, and a lot of the policymakers were, and that was the key reason why the approach that was taken was taken. I think this, I'm aware of the interview you're referring to.
Gentleman's time has expired.
But I don't think that was the prime motive.
Thank you. And the gentleman from Illinois, Mr. Foster, is now recognized.
Thank you, Mr. Chairman, and thank you to all the witnesses here. You know, there are a number of very interesting lessons the world, as well as our country, I think, should learn from this. In general, there seem to be three possible futures here. There's one possibility where Greece just leaves the union, repudiates the debt. And so if we go down that route, what would the immediate impact be on banks around the world, on bondholders and so on? Is that actually been worked out in any detail so that people have an idea of what that would look like?
Congressman, Greece's debt, for the most part, is owed to European official creditors, to governments, to European institutions that they set up, both the European Stability Mechanism, but more to the earlier mechanisms they had set up. So it's not really owed to banks so much, and so I don't think the impact would reverberate around the world. I think there's a bigger concern within Europe, especially after the UK vote to leave the European Union, that if Greece were to leave, it's showing that the continental system, the political system that they've struggled so hard to build, could start to fracture. I think that's why it's so important that the German-French, let's say, amity, or the good start to the new relationship, be cemented, and that they move forward on the internal reforms that they need.
It would also presumably have a bad impact on the creditworthiness of other Southern European countries that are in roughly comparable situations?
Yes, I think that could be a concern, because there's quite a bit of concern about Italy and its banking system, and of course, what those banks, what they owe to other creditors is not necessarily to official creditors, it is to other financial institutions within Europe. So there is, I think, a deeper worry there.
Right. So the other class of solutions, just a big haircut, both to the debtors, also the pensioners, I guess, are another potential entity in a position to take a big haircut.
Yes, they are going to have to pare back their pensions and take the kind of reforms that the IMF actually recommends to many countries. Older retirement ages contribute for longer periods, and a smaller pension. And this comes back to what I said earlier, that Greece ended up, once it joined the Eurozone and benefited from very low interest rates, ended up spending more on pensions, promising more to its citizens than it could deliver based on the real productivity of its economy.
Right. Yeah, it's the problem with having a monetary union without a fiscal union.
Exactly.
Is pointed out,
Yes.
by many people even at the time it was made. And that then, a future where you have potentially repetitive bailouts like that or haircuts like that ends up looking what I guess they call it a transfer union. Where there's just a systematic, it's sort of like what's going on in the United States, where there's a limited number of states, generally the large population states, that write a huge check to the rural and southern and western states. I know in my state of Illinois, we lose about $40 billion a year, which is numbers very comparable to the Greek subsidy, because we pay a lot more in federal taxes than we get back in federal spending. And these checks are largely written to, rural, southern states. And so, but this is the way we've lived for at least 40 years in the United States, and it has real long-term impacts. And so that is a possible future, that the Germans will just continually write checks to subsidize the pensioners in Greece. And I guess that's one of the things that makes it so difficult politically. The third possibility is just a massive increase in taxes and tax compliance in Greece. And so if Greece could solve the tax compliance problem, what fraction of the problem would that solve?
It would go partway towards helping Greece with its own internal resources for its own internal needs, but it wouldn't be enough to address their debt servicing requirements over the many decades of the future. Just they couldn't possibly.
And would, for example, a principal write-off followed by a much higher rate of tax compliance actually?
That, I think, could give them a clean slate and perhaps make it easier then to generate the domestic support for these kind of reforms that would make the economy more competitive and would broaden tax compliance and help them enforce better their own internal laws. I was in Greece a couple years ago and stunned at how difficult it is for them to even get compliance with their own, to get effective enforcement of their own laws.
Well, there's
and
that famous aerial photograph of, I guess it's the suburbs of Athens with all the swimming pools.
Yes.
And in an area that there were 3 registered swimming pools and hundreds of visible swimming pools. I guess my time's up at this point.
Thank you. The gentleman's time has expired. The chair now recognizes the gentleman from Ohio, Mr. Davidson.
Thank you, Mr. Chairman, and thank you to our guests. I appreciate your expertise and your presence here today. When solving problems, it's vitally important to address cause and effect and to understand what are indeed the root causes if we are to see a lasting solution. So as we've sat here and talked about haircuts to debt, I think we're glossing over how did we get here in the first place. Ms. Lunsger, has Greece addressed the root causes that led to their need for this new debt?
I think they've made quite a bit of progress in doing that, but no, they still have a number of structural reforms to undertake to make their economy more competitive, to make their workers able to work, to make their citizens willing to share in the responsibility of financing their government and accepting that they'll be getting somewhat, everybody, reduced benefits over time. So they still have a ways to go on that, and I think it's been very difficult, especially for countries like Germany, where they have managed to undertake labor reforms and managed to make many of the improvements over time to then continue with the prospect of supporting Greece. But that's going to be the likely outcome.
Yeah, thank you. You touched on a number of things there that I think are important. One is, you know, some countries in the EU have stronger economies than others. Some have reformed their economies and found themselves able to steer clear of a debt crisis in the first place, but even countries that did find themselves in heavy debt burdens have taken action to change course. I'd like to show a chart that shows, you know, the idea of debt in the EU. So this isn't something that's, as a few folks have alluded to, this is what that looks like and how Greece is, but it's certainly not alone. And the concern is, we mentioned it as a moral hazard, that once countries realize that they're seen as too big to fail, do you create the hazard that people don't change course? So I have another data point that just shows workforce participation. And, you know, this is a particularly acute problem in Greece. They're not the only country with this problem. But when you look at how few people are paying in, and you look at the debt, isn't the root cause just as simple as the gazautas are bigger than the gazentas? And what do we see as the systemic solutions to fixing that problem in Greece, and frankly, if the EU is to survive as an intact entity broadly?
Well, I think, Congressman, that you've highlighted one of the real challenges facing the European Union, the Eurozone in particular, which is how to understand that, yes, they're all in it together. They've all benefited from having this very attractive euro, this currency, especially Germany, because it's been a more depreciated currency than the Deutschmark would have been had they stayed as separate individual currencies. Yet that entails being partners with weaker countries. And how do you then enforce internally the kind of reforms that will bring more workers back into the labor force or bring debt levels down? And that's one thing Europe has not effectively been able to do internally.
Thank you. And you know, Dr. Nelson, if you could comment on that. I mean, this is a question that you see internationally. The IMF is supposed to be able to ratchet leverage with the loan, just like most creditors of last resorts. If you go out into the private equity market, companies that find lenders of last resorts find lots of warrants, clawbacks, tools that will effectively result in loss of control of the company. In the country, a country is a sovereign entity, and you have this complexity here where you've got a currency misaligned, and we talked about this piece. how can the IMF participate in Greece as part of this currency, multi-country currency agreement in the EU, and yet if we are to participate in the IMF, apply enough teeth to get the reforms that the EU themselves have not been able to show broadly?
Right, so I think the IMF conditionality that attaches to its loans has been a challenge. I think something that's come out from the panel is that there's been a real difference between the fiscal adjustment that has happened in Greece versus the continuing structural problems that continue to plague Greece. Some of the discussions right now are on taxes, pensions, unemployment, things that have been on the table for the past 7 years and have been subject to IMF conditionality, but there are questions, I think, about, after 7 years, how much progress has been made and or how much progress was reasonable to expect.
Thank you. My time has expired, and I just would add briefly that this is a challenge we're dealing with in the United States, and so as a participant in the IMF, the idea that the Americans are going to come to the rescue when we have our own crises to deal with domestically is increasingly dubious with our vote in the IMF.
The gentleman's time
Chairman, I yield back.
Thank you. The gentleman's time has expired, and without objection, the subcommittee will move to a brief second round of questioning, and the chair recognizes himself for 5 minutes. Ms. Lunsager, you have written that not only can Europe tackle Greece by itself, but further IMF involvement would only postpone reforms in the Eurozone, and I would ask for unanimous consent to submit for the record Ms. Lunsager's Reuters piece, quote, "The IMF must walk away from Greece," unquote. Ms. Lunsager is not alone. I would ask unanimous consent to enter into the record an op-ed from February by Princeton professor Ashoka Modi, a former deputy director of the IMF's Research and European Departments. His piece is entitled, quote, "The IMF should get out of Greece. The fund's involvement has been an unmitigated disaster," unquote. The views of Ms. Lunsager and Professor Modi have been echoed in Europe as well. The head of ESM, Klaus Regling, said in an interview last year, quote, "At this point in time, it is really not a question of IMF funding, but of using the IMF's technical expertise," unquote. Leaders in both Germany's conservative CSU party and left-leaning Social Democratic Party have also been quoted as saying that Europe can stand on its own 2 feet and no longer needs IMF's money in Greece. I would submit for the record this Reuters article from February 16th, headline, "German conservative Euro MP breaks ranks over IMF role in Greek bailout," as well as another piece, "German SPD says Europe can back Athens without the IMF." My question is as follows. For Ms. Lunsager, since I quoted your piece, your Reuters piece, is there any reason to believe that the IMF couldn't just limit itself to a purely advisory role as opposed to a financing role? And if the Europeans, including Regling, are saying that it's IMF's expertise that's needed in Greece as opposed to money, is there anything that would prevent the fund from just providing monitoring and technical assistance?
No, and that is my preferred option.
Yes. And Dr. Nelson, it's often reported that Germany and others in the Eurozone want the IMF in Greece because they don't have confidence in the European Commission. As Mr. Bluestein's work has shown, this lack of trust among Europeans has been a running theme since 2010. The question would be, doesn't taking advantage of the IMF in this way just let Germans and other leaders off the hook?
So I think Europeans did want the IMF involved to have the IMF stamp of approval that the program design would be sound, would be safe. However, there are questions about the co-financing arrangement and whether or not the IMF had the independence to do what it needed to do in the program.
And Mr. Bluestein, if the Europeans lack confidence in European institutions, isn't it up to the Europeans to reform them?
Well, that's an interesting way of looking at it. I mean, I guess my preferred option would be something like the following: that the IMF should be involved if it sees, using its best technocratic judgment, that the program has been fixed so that Greece's debt is sustainable, and that as I agree with Meg that it would be preferable if that involved a debt write-off, but it shouldn't just stop there by making a technocratic judgment about a specific deal that's struck in Brussels. there ought to be a lot of conditions imposed because the IMF's credibility has been damaged by basically being dragged, and as Ashoka Modi wrote, its reputation affected in the process. You know, one way of doing that would be to say, from now on, for this program and for any other, if we have to get involved in Italy, whatever, Portugal is not completely out of the woods, then from now on, when we're lending money to a country in a currency union like the euro, the countries that are on the IMF board that represent those countries, they don't get to vote. We're going to leave it up to the rest of the board to handle. And by the way, we want the members of the of those countries that are in this currency union to guarantee that the IMF will be paid back in full for sure if this doesn't work out. In other words, if Greece ends up defaulting on what it owes to the IMF, to protect the IMF's preferred creditor status. So, you know, the way you look at it is it's you know, that's sure. It would be great if Europe could handle this problem by itself. They have understandably gone to the IMF and said, we need your expertise, and to comfort ourselves that you are really comfortable with what we're doing, we want you to have some skin in the game, and that's another way of doing it. But if there's not complete comfort, and if these other conditions can't be met, then I would agree with Ms. Lunsinger that the IMF should walk away.
Thank you. My time has expired, and the chair recognizes the gentleman from Illinois, Mr. Foster.
Thank you. There's an amusing calculation that's, I think, been done by many people, that if you just go region to region around the world, you conclude that the world as a whole is a net debtor, which, you know, cannot mathematically occur. And so the reason, of course, is that various people are stashing money that's off the books in offshore accounts. And so I was wondering, you know, what fraction of, and there are estimates, I think, for the EU as to how much money is actually stashed offshore. How does that compare to the total shortfall that you're seeing in Greece? And is, you know, with that included, with estimates for the amount stashed, you know, off the books, is the EU and Greece as big a debtor as actually you'd conclude from the raw numbers? Do you have any feeling for how those numbers compare as possible sources of money to try to settle things here? You know, it's in the multiple trillions of missing, you know, of offshore accounts.
Congressman, I don't know the numbers, and I don't have a good sense of how much it is, but clearly, as you point out, this is the case. The problem is governments getting access to that, establishing the kind of policies that will bring that money back into the limelight, back into the sunshine, so that it can be taxed, it can be utilized. I mean, we saw how long it took to negotiate an agreement with the Swiss government, right, in terms of data and information sharing.
Sure.
So,
oh yeah, this will be politically very, very difficult,
yeah,
in no small part because of assets that may or may not be held by those in power in all of the European countries.
If I may add very briefly, Congressman, this is a multilateral problem that requires a multilateral solution, right? This is not something that IMF can fix with Greece, and I think that's what Ms. Lunsiger's
Right.
comment.
But a solution to that problem could actually, you know, at least be a partial solution to this.
It would do the world a whole lot of good.
That's right. So that, and actually the IMF may have a role in encouraging that globally. Another you know, possible endpoint that various wags have pointed to is that the way this will all end is that German investors will each have their own private Greek island at the end of this, or perhaps a 99-year lease on a Greek island if that's, and you know, and there's a lot of real estate with a very high potential market value under the control of the Greek government, and a very big political problem, even in, say, getting a 99-year lease that could be sold. But is the market value of that kind of real estate the same order of magnitude, you know, as the debt problem here? And is that at least a partial solution to this? Have there been serious efforts to make estimates of that?
Again, I don't have the numbers at my fingertips. It could perhaps help, but if they were to try and sell it all at once, a fire sale, I think it would be very difficult to to get the kind of returns that they were looking for. Nonetheless, every program with Greece, the effort has always been to push on the privatization, these inefficient state-owned companies, or even some of the better-off ones, to sell them to private entities to basically raise several billion euros for the government. So between that, between perhaps some of the real estate holdings, but any mention in Greece of selling the Parthenon or the Acropolis.
But large government-owned hotels,
No,
I guess,
I
are a
know what
perfect
you're
example
saying,
of
but
something that would have an immediate market value.
Right.
And those are difficult politically because they're paying salaries higher than would be justified by a pure market solution.
That's been part of the problem, that they do need to get back to competitiveness, which means restoring. Now, at the same time, because wages and prices have fallen in Greece, there has been some internal devaluation. It has helped make it a little bit more competitive, and of course, tourism continues to do pretty well, but otherwise, the productive sector is still languishing.
Yeah, Mr. Bluestein.
This was one of the great mistakes the IMF made in the early stages of the crisis. It was actually after the first bailout. It was in the spring of 2011. The IMF became kind of enamored of the idea that huge proceeds could be reaped by privatizing Greek state-owned assets, and the numbers were in the hundreds of billions of euros. So it was relative. It was sort of concomitant with the size of the debt. One of the problems was that there were, particularly involving real estate, which you mentioned, Congressman, there were so many squatters who had moved into these state-owned properties that it was politically just impossible for the government to, people had built homes, and to sort of sell that property off and evict those people was going to be that was one of the, there were many problems that arose as
The gentleman's time.
Okay, so 50 billion was the first number that was used. They've ended up being able to reap about €1 billion, I think, 2 billion maybe from privatization.
Thank you. The gentleman's time has expired, and finally, the Vice Chairman is recognized, Mr. Williams.
Thank you, Mr. Chairman. Earlier this month, the Slovak finance minister was reported as saying the amount of IMF assistance in Greece is not important. Instead, quote, it's really symbolic. So for Dr. Nelson and Lundsager, my question would be, what are the implications for the IMF if its lending becomes symbolic? Wouldn't symbolic assistance mean that the fund is straying from its traditional functions?
So the traditional function of the IMF is to lend to countries facing temporary balance of payments crises. It doesn't really say anything about the amount, but I do think we have veered from temporary. We're 7 years into the crisis. Greece is still reliant on financing.
Ms. Lundsager?
Congressman, it's symbolic perhaps isn't the best word to use because IMF participation can be very, very close in terms of recommendations on the policy formulation, the monetary, fiscal, financial sector policies, exchange rate if needed, and then can be part of the team that monitors performance and assesses how the country's doing in meeting its fiscal targets or its inflation target. And IMF lending doesn't have to be part of that at all. And we've seen that work pretty well with a number of low-income countries where the IMF actually established a policy support instrument which does exactly that. Has an engagement with the country invites the IMF in, but there's no IMF funding included in that. It's more of a partnership. So absolutely, the IMF can be there, and its catalytic role used to be would lend small amounts and then you'd bring in other creditors. It doesn't really need to lend anything if it's viewed as its assessment, its mark of sort of good progress is sufficient for the other creditors to participate.
Okay. Just quick follow-up. So if people think the IMF loan is symbolic rather than necessary, how do you assess the effectiveness of a program, and how would the fund's evaluation officer, or anyone else for that matter, evaluate symbolic lending?
Well, for example, with the low-income countries, there's actual a board review. Staff go out for periodic reviews, assessments, and it comes before the IMF board. So it is a formalized, in that case, a formalized process. It doesn't necessarily have to be that formal, but the IMF prepares all sorts of papers all the time. If nothing else, the annual Article 4, the annual review of an economy. And so that can form the basis as well of monitoring. But if the country invites them in and asks the IMF to prepare a report and share it with the board, make it public, then that's a way of reinforcing that role of the IMF as a designer of the policies and monitoring them as well.
Ms.
I
Nelson?
may augment that.
Oh, go ahead, please. No, go ahead. That's fine.
I'm sorry. The IMF's traditional role was to support the gold exchange standard, right? It has evolved to become a big player in crises and debt restructuring. Today, the task is precisely to make the fund effective in a world where it can never be, or it can very rarely be, a huge financial player, as well as being effective on a regional scale. So, it did manage to go to Article 4 for the Eurozone. That's a good thing. Whether it's able to stay effective with no money or very little money on the line, I think is a task for them and for us.
Ms. Nelson? Dr.
So
Nelson?
I think it would be difficult to assess the symbolic sort of contribution of the IMF. However, I do think, any sort of IMF involvement in a country can be judged against metrics of, is the country able to re-enter capital markets at the conclusion of the program? Is the economy stabilized at the conclusion of the program? These sorts of metrics, I think, can be assessed regardless of the amount of money contributed.
We've got a short time left. Dr. Bluestein?
I think you've gotten brilliant answers from my three colleagues here. I can hardly think of anything to add to it. Yeah.
Mr. Chairman, I yield my time back.
Thank you, and I'd like to thank our witnesses for their testimony today. And without objection, all members will have 5 legislative days within which to submit additional questions for the witnesses to the chair, which will be forwarded to the witness for the response. I'll ask our witnesses to please respond as promptly as you are able. And this hearing is now adjourned.